Hello, my name's Nick Dingemans. Welcome to episode 4 of the Anatomy of an LNG to Power project. Today's episode is the construction, financing and operation of a floating storage regas unit. I'm a corporate energy partner based in Singapore, and today I'm joined by my colleagues Joe McGladdery, Gary Walsh and Heike Trischmann. They're all based in London. In episode 1, Heike and I discussed the structuring and contracting strategies to mitigate the project-on-project risk of LNG to power projects. In episode 4, we looked at the construction, financing and operation of a power plant in an LNG to power project. To complete the value chain, Gary and Joe will look at the value chain from the view of an FSRU and their role in an LNG to power project. After Gary and Joe have finished, Heike and I will join again for a short panel discussion and to cover your questions. Please send us your questions in the Q&A function and we will try to address all of them. Any questions we can't get to, please do contact any of the speakers on the contact details on your page in front of you. This session is being recorded and the slides and the session will be made available to all participants and will also be hosted on our LNG to Power landing page on the Watson Farley Williams website. As the world moves towards a goal of net zero, we think that LNG will be a key component in that transition. Natural gas and LNG, especially if they can in the future be blended with hydrogen or potentially in the change to synthetic gas produced from biosources, are well placed to support this global transition, not least in the power sector. In the last 15 years, the LNG sector has evolved from the traditional point-to-point system to a dynamic market with integrated components and new participants. This has been driven by a combination of the development of floating modular construction, both for upstream liquefaction and in the downstream for the regas. In addition, new trading models have been developed by LNG aggregators and portfolio traders, and new pricing models produced by those traders have then allowed new LNG participants into the market. Although LNG to power projects focus on the supply to the market, the full value chain comprises various segments that need to be synchronized. As you can see from this slide, the value chain follows the traditional upstream, midstream and downstream model. In the upstream segment, development of floating modular construction of vessels and barges within the last 10 years has allowed new access to reservoirs which would otherwise not have been available, either for being too small, too remote, or too far away from market. In the midstream, the introduction of the LNG aggregator supply model has produced a more liquid, fungible market. This market has also become deeper and more complex with the addition of portfolio buyers. The availability of floating regas and storage units, FSRUs and FSUs, has allowed access to new jurisdictions and the gasification of markets where gas has never been an option before. The downstream segment, i.e. the LNG to power project itself, is in many ways the newest part of the chain and consequently evolving in many parts of the world. While the introductions of FSRUs creates infinitely more flexibility, an FSRU being linked to a dedicated power project creates a more complex matrix of project-on-project risks than traditional models do. This risk matrix, the risk matrix created by an LNG to power project, impacts each part of the downstream segment of the value chain. A solution in one jurisdiction is unlikely to work in precisely the same manner in another jurisdiction due to local law differences. Structuring contract strategies and available contractual toolbox can be combined in different ways to help mitigate the risk that unfolds in each buyer country. I'll now hand over to Gary and then to Joe to talk about the construction, financing and operation of FSRUs and how this fits into the overall value chain. So I'll hand over to Joe now. Sorry. Sorry, Gary.
Thanks, Nick. Good morning, everyone. My name's Gary Walsh. I'm a partner in the Assets and Structured Finance team at Watson Farley Williams in London. And I'm going to talk to you today about the funding of SFRUs from the lender side and borrower side. So I'm first going to speak about the various sources of funding available for financing FSRUs and what we've seen in the market. Sponsors are continuing to provide equity for projects, and commercial banks providing debt finance for FSRUs and the projects they are employed in. The financing for the FSRU usually takes the form of asset-based lending secured over the FSRU with usual mortgage security. The lending may be used to purchase the FSRU, to pay for the construction or conversion costs, or to fund OPEX and CAPEX costs. Depending on the location of the FSRU and its strategic importance, it may be that development banks or multilateral banks are involved to provide more cost-effective funding. We do also see that capital markets are likely to become more involved in the future, but they do demand more certainty that can probably be offered in the early stages of a project. Just moving to the next slide. So how can the funding risks be mitigated? Well, sponsors can provide the experience and have the committed funds, and they should have in place sufficient equity to ensure that possible cost overruns can be covered. Commercial banks can provide further risk mitigation, and we often see commercial banks providing cost overrun debt facilities, which can avoid the need for sponsors to cover this with equity. We also see commercial banks providing revolving credit facilities to cover revenue shortfalls, which could otherwise impact on working capital and/or debt service. As well as the lending roles, commercial banks can also help simplify the financing process by taking on roles such as a technical bank, the model audit bank, and documentation bank. Each of the roles can be seen as a way of simplifying the financing process and helping to achieve financial close more quickly, and thereby de-risking the financing process a lot quicker. Export credit agencies are also a very good source of cheaper funding, but of course do rely on there being local content requirements if they do have the appetite to become involved. And this can be by way of direct lending, guarantees of the commercial debt, or as insurance providers. And when we do see them involved, they do tend to drive the due diligence process, but often follow the lenders on the documentation risk. So moving on now to talk about sort of the lending and the corporate structures that we see. Corporate structures were addressed in detail by Nick and Heike in the first of this seminar series. But broadly speaking, we're seeing the following three types of structures. The first is where the ownership of the FSRU and the LNG to power project falls within one umbrella group. As you can see on the top slide, this is what we've known as the integrated structure. The second option is where there's an entirely separate ownership of the FSRU and the power special purpose company, here on the left-hand side of the slide, called a standalone structure. And the third structure is a hybrid of the first and second options, where the FSRU sponsor may have part ownership of the FSRU and the power SPV, and vice versa, the power sponsor may have partial ownership of both the FSRU and the project. I think the main takeaway from this slide is that there's no real standard approach to the corporate structuring, and it really depends on the circumstances of each project. So moving on to the lending structures we're seeing. Here are a few examples of the potential structures. Again, there's no real one size fits all structure, and the lending is going to be heavily reliant on the requirements of each project and its sponsors. But just by way of example, within the integrated corporate structure, you can see that there's one group of lenders who lend on the same terms, usually with one security package into the holdco. The holdco then on lends to the asset holding SPVs. The asset holding SPVs would then be expected to provide upstream security for the holdco's obligations to its lenders. There are various issues where upstream guarantees and security could cause particular legal issues, and this is something that would need to be considered as part of the legal DD process. I won't talk too much about the cross ownership, but in terms of the standalone lending structure, you can see that there are two sets of lenders which introduce their own issues. There may be lenders who participate in each loan, but the two facilities are separate loans with separate security package. In this instance, we have one syndicate which lends to the asset SPV and the other lends to the project SPV. Each set of lenders have their own set of credit risk requirements and risk protections. And I do go on to look at some of the intercreditor issues later on in this seminar. So having had a high level look at the sources of funds and the corporate and lending structures that we see in LNG to power financings, Joe and I are now going to have a more close look at what lenders are trying to achieve in their bankability assessments, both from the lending perspective and the contractual perspective. As you can see on this slide, there are numerous considerations when trying to achieve bankability of an LNG to power project, particularly when looking at the financing of an FSRU. This slide sets out the entire risk matrix that affects the whole project. A number of these issues were addressed already in detail by Manuel and Daisy in seminar 3 of this series. So I think I'll now go on to look at the financing aspects and what lenders are looking for from a bankability perspective. So where do project finance lenders focus? Aside from the mortgage over the FSRU and an assignment of the insurances in respect of the FSRU, cash flow is high on the lender's list of concerns when it comes to looking for security for the loan. Lenders will want control of the cash flow, which I'll look at in more detail in the later slide, but also certainty that in difficult times, lenders will be able to take control over the cash flow through its security package. Local law requirements in the jurisdiction of the operation of the FSRU will impact on this and will need to be considered as part of the due diligence during the financing process. If the financing is being provided on a non or a limited recourse basis, then the lenders will be particularly interested in the security package and that it provides certain access to the FSRU and the insurances in place. Mortgages are a well-used tool for lenders, but the ease of enforcement does of course depend on the location of the FSRU at the time of the enforcement. Aside from mortgages, other typical security that we see includes account security, debentures of any other assets of the FSRU owning company, share security over SPVs, assignments of underlying contracts, including the FSRU Charter, and subordination undertakings from other intercompany creditors. We most often see, pretty much, no, not 100%, 99% of the time, the FSRU asset being held by a special purpose vehicle, which allows for ring fencing of that main asset and provides insolvency remoteness for the comfort of lenders. If lenders are financing the conversion or the construction costs of the FSRU, then lenders are going to focus in on when project construction risk starts and ends, with the aim to dovetail the lending structure during that period with the contractual milestones under the construction contract or the conversion contract. And we do see more reliance being placed on a recourse to sponsors during this stage than once the FSRU is operating within the LNG to power project. Similarly, where lenders are financing the FSRU following commencement of operations, then lenders are going to be equally interested in understanding when project operation risk starts, and will aim to structure the lending appropriately around that milestone, including putting in place the available security at the first opportunity. So just moving on to the next slide. The aim of the lenders will be to deal with any residual risk, and this is dealt with through the facility agreement and ancillary contracts. So the lenders want to know that the underlying contracts on the project provide for long-term revenue protection and that the security package provides sufficient access to those revenue streams if the borrower defaults. So following initial due diligence, lenders will require a number of practical control mechanisms to be built into the facility documents. These can include reserved discretions, whereby the FSRU owner undertakes not to act on certain of its rights and discretions under the underlying documents without lender approval, or to act on rights and discretions at the instructions of the lenders. The FSRU owner will be required to covenant to the lenders that it will not, amongst other things, change the project contracts, change the capital expenditure program or debt program without lender consent. These are key elements of the project which the lenders will want to control to restrict changes in their underlying risk profile. Further control will be sought through a set of representations and warranties, and these can include the financial, legal and commercial status of the FSRU owner, the construction, the operation and performance of the FSRU, and the FSRU owner's compliance with its obligations. Lenders are going to expect clear performance, revenue and maintenance provisions in the facility documents to ensure the protection of ongoing cash flows and asset value during the life of the loan. And these undertakings can be broadly split into positive and negative. Positive undertakings can include compliance with contractual obligations, compliance with legal obligations, in particular in relation to the FSRU and any taxes that may be payable. They will deal with the taking out and maintenance of insurances, and the FSRU owner diligently pursuing its rights under the project contracts. Negative undertakings will include that the FSRU owner should grant no other security, that there possibly is no other debt, at least not more senior than the facility. There's no asset disposal, no other contracts or liabilities, and in certain circumstances, no other distributions or repayment of any intercompany debt. Lenders are going to also want to receive prompt, up-to-date information, and there are numerous information covenants built into facility agreements dealing with the operation of the project and the performance of the FSRU, including downtime or scheduled or non-scheduled maintenance. In sort of taking a step back from the specific undertakings and reps and warranties, a breach of these undertakings or reps will not necessarily be seen as lenders as a route to claim damages, but instead as a method of calling an event of default, thereby preventing further drawdowns or accelerating loans that have already been made. It's essentially a method to get all parties to the table to discuss any issues, but in a worst case scenario, does give the lenders the option to enforce security. There are two other typical issues we see that lenders want to deal with. And these are mandatory prepayments of the facility and direct agreements. So the facility agreement will include mandatory prepayment provisions to ensure that lenders receive a full payout of the loan on a total loss of the FSRU, potentially also on a termination of any underlying contracts, including the FSRU Charter, and in some instances, change of control restrictions. Lenders will also consider whether they want the owner to procure direct agreements between the lenders and important third-party contractors to allow the contracts to continue with the lenders in the event the FSRU SPV fails to comply with those underlying contracts. And the direct agreements would usually include the ability for lenders to step into those contracts if the borrower or a project is not performing. So I briefly spoke about cash flow being central to bankability issues. Lenders will want control of the project cash flows to ensure that they are received into ring-fenced secured accounts, and that those cash flows are used to build up OPEX or CAPEX reserves or maintenance reserves, and also debt service reserves. On this slide, I've set out a typical cash flow structure and how we usually see cash flows being dealt with, but it of course is, with all these things, dependent on the structuring of the specific deal. But just running through this cash flow waterfall, once the earnings have been received, then we usually see operating costs being accounted for first to allow for the FSRU project to be funded and these could include any taxes that may be payable. Secondly, the earnings would then be applied to pay debt financing costs, including any ECA premium, interest costs, or associated hedging costs. Next, it could be that the earnings are then applied to fund any reserve accounts, such as the debt reserve account or any maintenance reserves that have to be built up for the maintenance of the FSRU. Then the fourth level distributions would likely to allow for any mandatory or voluntary prepayments of the debt facility, with the final level being any surplus being made available to the borrower for distributions or prepayment of shareholder loans. So finally, just looking to the intercreditor arrangements, which I briefly touched upon at the start. So where you have separate project lenders and FSRU asset lenders, then the two syndicates will want to try and ensure that the cash flows from their particular part of the LNG to power project are protected. Specifically, the project lenders will want to know that the asset lenders are not going to withdraw the FSRU from the project unexpectedly, and vice versa, the asset lenders will want to know that the project lenders are not going to pull the plug on the project without notice and leave the financed FSRU without a project. So how are these inter-lender risks mitigated? Each lending syndicate will likely want to have intercreditor arrangements in place with the other lending syndicate, which broadly deal with three things. The first is a standstill period. If there's a default under the FSRU loan, then the project lenders will want to be informed of that default, and for the FSRU lender to grant a standstill period, during which time the FSRU lenders cannot take action to enforce its security. Typically, the standstill period goes hand in hand with a cure right. So during the standstill, the project lenders may want to have the right to be able to cure any FSRU loan default, thereby removing the FSRU lender's right to enforce its security. Finally, an ancillary right is a step-in right, where the project lenders have a right to step into the borrower's position under the FSRU loan and continue with the loan in place of the borrower. It would usually be another SPV financed by those project lenders. The above three rights would apply equally also to a default under the project loan, with similar rights given to the FSRU lenders. Finally, depending on the structure in place, the end user of the FSRU may also request a quiet enjoyment right from the FSRU lenders. So to the extent that the end user is paying the contracted sums under the FSRU Charter, then the FSRU lenders will be asked to waive their right to enforce its mortgage security or otherwise interfere with the end user's right to use of the FSRU. This, of course, gives more certainty not only to the end user, but also to that particular company's financiers. I'm now going to hand over to Joe, who's going to take us through the contractual considerations.
Thank you, Gary. Just moving slides. There we go. Good morning and good afternoon, everyone. For those that attended our first webinar of the series, and as I briefly touched on at the time, we've seen charters for FSRUs evolve from a format similar to those for LNG carriers, whereby the regasification warranties and the ancillary provisions required for the regasification are added to the standard chartering terms to really significantly more bespoke contracts where the rationale is far more closely linked to the provision by the FSRU sponsor of the service of supplying regasified LNG. In relation to LNG to power projects in particular, we generally see the function of the FSRU Charter split into the two separate contracts as shown in this slide. Firstly, a bareboat charter entered into between the FSRU sponsor as the registered owner of the FSRU and the project developer, here referred to as the onshore facilities operator. And this gives the project possession of the FSRU, and then an accompanying operation and maintenance agreement, or O&M contract, pursuant to which a locally incorporated affiliate of the FSRU sponsor, the FSRU operator in this case, will agree to operate and maintain the FSRU for the duration of the bareboat charter. Now, this structure is usually required for two reasons. Firstly, there may well be local law requirements in the host jurisdiction that require the FSRU to be operated by a locally incorporated contractor. And secondly, for tax reasons, so that only the service element, as compared to the capex element of hire payable under the bareboat, is taxed within the host jurisdiction. However, for the purposes of this webinar, we will refer to the contractual arrangements between the project and the FSRU, the FSRU sponsor, simply as the charter. And I should also add that, to keep things simple, when I refer to the FSRU sponsor, I generally mean to the traditional companies whose business is the construction and the operation of FSRUs, whether that relates to the registered owner of the FSRU or the operator if they are different entities. And for the avoidance of doubt, again, if when I refer to the project or the project company, I mean the project entity that is actually chartering the FSRU. But irrespective of the contractual structure that is adopted, as Gary mentioned, there are a host of issues that will be scrutinized by both the FSRU sponsors and its lenders in order to determine the extent that any particular project lends itself to a project financing structure. And it is these issues within the commercial contracts for the FSRUs that we will look at now. Now, whether the FSRU is being constructed as a new building or converted from an existing LNG carrier, from the time that the charter and the underlying construction contract are executed, there will be close coordination between the parties in relation to the construction of the FSRU and the construction of the power plant and accompanying jetty and pipelines. For obvious reasons, the project will want to make sure that the FSRU is delivered by the FSRU sponsor and will be accepted by the project at the project site no later than the date at which the site facilities are able to receive a commissioning cargo, and certainly no later than the date on which the power plant is able to accept feedstock gas. However, during the FSRU's construction, there will be various risks that will fall outside of the FSRU sponsor's control, for which the FSRU sponsor will not be willing to accept responsibility. And it will want to ensure that any permissible delays, i.e. for force majeure, that are claimed by the builder under the construction contract will operate to automatically extend the time for delivery under the charter. The FSRU sponsor will also want delays attributable to the fault of the builder to extend delivery as well, although the project will usually require any liquidated damages payable under the construction contract, or at least a large portion thereof, to be paid onto the project. Now, clearly the FSRU sponsor will not wish to pay more liquidated damages to the project than it received from the builder, and ideally substantially less to cover its own costs for delay in delivery from the shipyard, such as financing costs, increased supervision costs, etc. Ultimately, should there be a significant delay in the construction process, there will be a right on the part of the FSRU sponsor to terminate the construction contract. In such event, the project company will either have the right to request the FSRU sponsor to maintain the construction contract, and delivery of the FSRU under the charter will have to be commensurately extended, or the project will have the right to step into the construction contract in place of the FSRU sponsor to enable the project to take, albeit delayed delivery of the FSRU from the builder should it so wish, at which point the underlying charter would terminate. However, the FSRU sponsor needs to be very wary that termination of the charter as a result of breach by the builder or extended delay does not in itself entitle the project to have a claim and damages against the FSRU sponsor for breach of the charter. But during the construction process itself, the project will want to have the right to oversee certain elements of the FSRU's construction to ensure that the unit is being constructed in accordance with the terms of the agreed technical specification. It is likely that the project will also want to confirm its technical acceptance of the FSRU prior to the FSRU sponsor having the right to take delivery of the unit at the shipyard from the builder under the terms of the construction contract. In terms of such technical acceptance, there will be a detailed testing regime, both in relation to the sea and gas trials, that will need to be carried out on the unit prior to its technical acceptance by either the project or the FSRU sponsor. And in the event that there are defects determined during such tests and trials, these defects will need to be rectified by the builder prior to delivery. Usually it is not possible for all of the unit's technical capabilities to be fully tested at the shipyard, in particular in relation to the rate that the FSRU is able to send out regasified LNG, which often can only be tested fully when the unit arrives at the project site, where there are facilities to receive LNG and discharge regasified LNG. However, title in the FSRU will ordinarily pass from the builder to the FSRU sponsor on delivery at the shipyard, not at the project site. And therefore, there will need to be significant testing regime set out in the construction contract, under which, as between the builder and the FSRU sponsor, the builder is responsible for undertaking the remaining testing of the FSRU upon its arrival at the project site. And of course, the performance warranties that the FSRU sponsor provides to the project under the charter should be as closely aligned as possible to the performance warranties of the unit as stipulated under the construction contract. So this really is a key element of both the construction contract and the charter. And it is important to ensure that elements such as timing, procedure, and responsibilities are matched as closely as possible between the two contracts. But provision will also be required in the event that the designated milestones for the project do not run to the intended schedule. If the FSRU is delayed in arriving at the project site, or the unit fails during testing to comply with the acceptance criteria, so that delivery at site is delayed, the project will expect to receive some level of compensation by way of liquidated damages for each day the unit's delivery to the project is delayed. Now, it's highly unlikely that the level of compensation that the FSRU sponsor will be willing and able to pay will be sufficient to fully compensate the project for the losses incurred, especially if the FSRU is the one element of the project that is delayed. And the project company will need to manage these costs through its analysis of other contracts, such as the LNG sale and purchase agreements, the power EPCIC contract, and the offtake arrangements, etc. However, the FSRU sponsor will again not accept liability for delays for which it is not responsible. Consequently, for delays under the construction contract attributable to the builder, including delays in testing or failure to meet the required acceptance criteria by the scheduled acceptance date under the charter, the FSRU sponsor will look to the builder for reimbursement of any liquidated damages that it is obliged to pay to the project. Similarly, the FSRU sponsor will not be prepared to accept any delays attributable due to the facilities at site not being ready to accommodate the FSRU, which in turn delay the FSRU sponsor's ability to undertake the final acceptance tests under the charter. Now, as previously mentioned, title in the FSRU will ordinarily have passed from the builder to the FSRU sponsor upon delivery of the FSRU from the builder at the shipyard. And so the FSRU sponsor will look to the terms of the construction contract and the builder to rectify any defects that are determined during the testing of the FSRU whilst at the project site, which may entail the builder being obliged to pay liquidated damages during the time it takes the builder to rectify such defects. But ultimately, the biggest risk in the interface between the FSRU and the power plant is the unfortunate scenario where, once installed at the project site, the FSRU is unable to satisfy the minimum acceptance criteria, despite the FSRU sponsors and the builders' efforts to rectify the defects. Now, the Charter will set out a long stop date by which the FSRU will have to satisfy the acceptance criteria, or the project will have the right to terminate the Charter. However, in these circumstances, termination is likely to be the last resort for the project, because, of course, without the FSRU, there will be no project, at least in the short term, until a replacement unit can be found. Therefore, depending on the severity of the defect, the project may want to maintain the Charter and the FSRU, even with the defect, and may either accept the unit against payment of the liquidated damages and an adjustment of the warranty, or a pro rata reduction in the hire rate to compensate the project for its deficient performance. Neither of which, of course, is ideal for the FSRU sponsor or its lenders. But in the unlikely event that the project does end up terminating the Charter, the FSRU sponsor will now have title to a deficient FSRU and no employment contract. And it's highly unlikely that it will have the right to redeliver the FSRU back to the builder, and instead will have to accept the payment of liquidated damages in lieu of the defect, which almost certainly will not cover anything like the losses the FSRU sponsor will suffer over the life of the asset. And for this reason, it is very likely that the lenders will require some form of recourse to the FSRU sponsor, at least up until the point in time that the FSRU sponsor, the FSRU has been delivered and is fully operational without deficient performance. But once delivery at the site has been achieved, the parties now enter the operational phase of the project with a very different set of risks and challenges. As Gary mentioned earlier, the lenders to the FSRU sponsor will be looking closely at cash flow, and therefore any provisions in the Charter that provide for a reduction or deduction in the hire rate or service fee will be scrutinised very closely by the lenders. Now, in very general terms, the main reasons that would entitle the project to a reduction in the level of hire would result from deficient performance, the send out of non-compliant gas, and also for events of force majeure. So taking these briefly in turn, clearly two of the key performance criteria for the FSRU will be: one, the rate at which the unit is able to load LNG from a laden LNG carrier at the site, and two, the rate at which the unit is able to send out regasified LNG. And there will be detailed provisions within the Charter relating to the establishment and determination of such warranties, combined with the financial consequences of any such deficiency. Now, for example, if there is a failure on the part of the FSRU to send out the daily nominated amount of regasified LNG, such deficiency may result in a pro rata reduction in the daily rate of hire, i.e. a 2% deficiency results in an equal 2% reduction in the charter rate. Alternatively, we have seen some charters that apply a more punitive regime, such as for a 1% deficiency, there may be a 3%, say, deduction in the hire rate. There will also ultimately be a threshold, say below 75 or 80%, at which the project will be entitled to place the vessel off hire or out of service, depending on the relevant technology. In addition to a reduction of hire, we have seen some developers impose a regime where the FSRU sponsor is liable for a proportion of the actual damages that the project suffers as a result of the FSRU's deficient performance. But the possibility of the FSRU sponsor being responsible for direct damages incurred by the project, even if there is a general cap on liability, will, needless to say, be of significant concern to the FSRU sponsors and the FSRU sponsor and its lenders alike. Possibly a more balanced approach relating to a deficiency in the unit's capability to load a cargo of LNG is that there will be a pass-through of the demurrage costs that the project may be liable to pay the owners of the calling LNG carriers at the facility under the terms of the LNG sale and purchase agreements. This potentially is an acceptable remedy for the project, subject, of course, to agreement on the potential quantum of the demurrage claim. And in the event that the FSRU sends out regasified LNG that does not conform to the agreed specifications, then provided the LNG that was loaded on board the FSRU was not off specification itself, the FSRU sponsor will again usually have to accept some liability for losses incurred by the project resulting from the production of such non-conforming gas, including the cost of the LNG that was regasified. And while certain reductions in the charter rate for deficient performance are largely standard, the lenders will look closely at each of the circumstances where the FSRU sponsor may be penalised on a case-by-case basis, and will ultimately take a view as to whether the nature of the risks and their potential amounts are acceptable or not. So, turning now to force majeure, the events that constitute an event of force majeure will be heavily negotiated. And the Charter will also differentiate between events of force majeure that affect the FSRU sponsor and those that affect the other elements of the project. And the remedies that follow each type of event will also differ. Excuse me. If, as a result of force majeure, the performance of the FSRU sponsor or the use of the FSRU by the project is interrupted, the project will often have the right to terminate the charter if the event in question affects the FSRU's performance or the project's use of the FSRU for a defined period of time, for example, say 12 months. However, if the project's right to terminate arises from an event of force majeure that affects the power plant and related facilities as compared to the FSRU, then it is likely that the FSRU sponsor will require the project to pay a force majeure termination fee for termination of the charter for reasons that fall outside of the FSRU sponsor's control. Now, during the period of force majeure, the FSRU will generally either remain on hire at an agreed rate that will allow the FSRU sponsor to cover debt service, or it will be at a reduced rate commensurate with any reduction in performance that results from the force majeure. Needless to say, neither the FSRU sponsor nor its lenders will want the project to be entitled to maintain the FSRU under the charter for an extended period at a reduced day rate. And in such circumstances, the FSRU sponsor will usually require the right to terminate after an agreed period where the FSRU is subject to a reduced rate. Now, at this point, it is probably worth mentioning there is likely to be a detailed regime setting out which party is responsible for obtaining the relevant authorizations, permits, licenses, etc., and the consequences for the relevant party of its failure to obtain such authorizations. Broadly speaking, the FSRU sponsor will be responsible for obtaining all authorizations required for the importation of the FSRU into the relevant jurisdiction and for its operation at site during the charter period. And the project will be responsible for all authorizations relating to the facilities at the site, the importation of the LNG, and of course, all requirements relating to the construction and operation of the power plant. Any failure on the part of the FSRU sponsor to obtain any relevant authorization which interrupts the project's use of the unit will result in the FSRU being placed off hire until such time as the authorization has been obtained, and ultimately a right on the part of the project to terminate the charter in the event that such breach is not rectified within the stipulated period of time. However, each party is generally only liable to obtain the relevant permits that are in place and that are required at the date of the charter, and there will be a separate regime for addressing authorizations required as a result of a change in law or which constitute an event of force majeure, and we address these issues in the next slide. I think it goes without saying that the project's termination right is the ultimate sanction against the FSRU sponsor. And whilst the project's right to terminate in certain circumstances is generally accepted as market standard by both the sponsor and the lenders will still want to understand under what circumstances the project can terminate. We look into the change of law provisions in the next slide, but termination for events such as total loss, requisition of title, and breach of sanctions are all relatively accepted termination events. Termination for either party's default will also be included, but which events constitute a default will be heavily scrutinized. Now, change in local law requirements are often both complex to determine, given the nature of the host jurisdiction, and the subject of lengthy negotiation. In general terms, any change in local law relating to the facility's infrastructure, including any physical modifications required to be made to the FSRU, are likely to be the responsibility of the project. Although the responsibility for any change in law relating to the operation of the FSRU will usually fall to the FSRU sponsor. That said, this is a very broad generalization, and it may well be the case that in any given jurisdiction, it is clear that a change in law or decree from a particular authority could have a wide-ranging impact on the project generally, requiring a particular provision within the Charter to address that scenario. It is also the case that a change in law may constitute an event of force majeure, with the subsequent rights of termination that this affords either or both of the parties. So it is clear that changes in local law can be problematic, and the propensity for such changes will need to be understood through an adequate due diligence process, with appropriate provision included where necessary in the contracts. But changes in international law are usually more straightforward, as they tend to be forecast well in advance. In this regard, changes in international regulations that require physical modifications to be made to the FSRU, i.e. changes in the rules of the Classification Society, will usually be for the account of the FSRU sponsor. But otherwise, any change in international law that affects the other elements of the project are likely to constitute an event of force majeure, with the remedies as we discussed. So just as a final point on this slide, the lenders will have their own view as to the risks involved in the FSRU sponsor undertaking a long-term and possibly strategically important project in the jurisdiction in question. As in the event of default under the loan facility and ultimately the enforcement of lender security, it may not be sufficient for the lenders to obtain possession of the FSRU. They will also need to be able to remove the asset from the relevant jurisdiction. In this regard, the lenders will need to consider the risk of local detention of the asset, irrespective of their ability to obtain possession. However, I think needless to say, this raises some pretty complex issues and potentially is a subject of a separate webinar in itself. But in summary, I think it's fair to say that these are complicated projects, and the provision of the FSRU Charter will interact not only with the construction contract, but also elements of the LNG sale and purchase agreements, the EPCIC contract in respect of the power plant, and the offtake arrangements. Consequently, the contractual positions we have raised here can only be taken as a guide as to how the rights and obligations of the parties fit together within the contractual lattice. Ultimately, of course, these are commercial arrangements that can be negotiated by the parties as they see fit. But if the FSRU is to be project financed, then ultimately the terms of these contracts will have to pass the detailed scrutiny of the FSRU sponsors lenders. So on that basis, I will hand back to Nick for the Q&A session.
Thanks, Joe. Heike and Gary, if you can join us. There you are. Sorry, I had my chat over the top of your faces. Thanks for joining. Heike, thanks for coming in. So a little bit of a panel discussion before we move on to the questions that have come in. Heike, probably the first one for you. Joe was talking about that testing and acceptance phase for the FSRU and the issues around the FSRU's owners and liquidated damages. And then he talked briefly about sort of the wider contractual toolbox that emerges from the rest of the value chain. What's your experience of that and the types of contractual tools and structuring options that you can use from those other parts of the value chain?
Thanks, Nick. And yes, good morning, good afternoon to everybody. So Joe has spoken about the interface between the FSRU and the shipyard and the FSRU, well, the FSRU owner, I mean, and the project company, which is usually the onshore gas infrastructure company. There will be other contractual interfaces, so one with the downstream gas off-taker, i.e. the power plant, and also one obviously with the supplier of the commissioning LNG. So where there is third-party access or a tolling structure in place, as we have seen and we discussed in episode 1, then there will be an additional interface between the FSRU onshore facilities owner, i.e. the HAPCO, and the toller, the user who will toll the LNG through that contractual structure. And obviously all of these interfaces will be affected if things go wrong, particularly in testing. So regarding the mitigating risks in relation to the downstream off-taker, we looked at this at episode 3 in particular, and I'm not going to talk about this again here. But regarding the interface between the FSRU project company and the toller, the scenarios for testing and relevant outcomes are largely the same as Joe has already described for the interface between the FSRU and the project company. And so we now need to make sure that these test criteria and consequences of a failed test need to be fed through the project agreement, the other project agreements, if they cannot be mitigated effectively. And so actually it may make sense to start negotiating that tolling, that access agreement to the facilities before you negotiate your charter, because at least you know what your user wants to, you know, where they're going and what they want to achieve. Obviously, the project company, if there's something wrong with the onshore gas infrastructure, they need to have a pass-through of liability to their EPC contractors for any defects. So that's a bit outside, I guess, this webinar as well. In relation to the LNG supply, so the user obviously has to get the LNG ready for testing purposes on the testing date, and if it doesn't do that, then the infrastructure quite often becomes deemed accepted, because obviously the FSRU and the onshore facilities are ready, but they can't do it because they haven't got the LNG. And so the fees become payable nevertheless, even though there's a test being done. And then the subsequent shortcomings may in fact reduce the fee in the way Joe described. So the test will be done at a later stage, but fees become payable straight away. The commissioning cargo itself may be procured under spot or as part of the long-term sales arrangement with the LNG supplier. In each case, we would highly recommend to document that this is a commissioning cargo which is coming in, because obviously the testing will be stop and go. There may be waiting times, and in order to avoid demurrage payments, it will be necessary to anticipate all of this in the LNG supply agreement. And also there may have to be a right to divert the cargo altogether if things go badly wrong. One thing we have seen, which is perhaps interesting to mention here, is that depending on timing, particularly where it's short, the FSRU may come in fully laden. and then obviously it has to pick up the cargo FOB somewhere, and then there needs to also be a subcharter of the FSRU for that journey, and that needs to obviously be permitted in the charter. It should be noted perhaps that in case only of the usefulness of this is only to test the onshore facilities. Obviously, you cannot test the loading facilities, the ship-to-ship transfer, if that is what happens, because obviously there is no tanker to do that. But it will have done that obviously upon loading of the FOB cargo and potentially the shipyard already. The advantage is that you gain time, particularly because the FSRU doesn't need to be purged and cooled down at the site of testing. It already comes fully with the LNG cargo, and the test can start straight away. So that just a few thoughts on that.
Okay, that's great. Thank you, Heike. A few questions that have come in on the Q&A, and I think, Gary, I'll give you the first one. In terms of long-term revenue protection, is there a minimum contract tenure imposed by the lenders?
Thanks, Nick. I think the minimum contract tenure will be tied into the loan term, and the loan term will obviously be dictated about the revenue streams under the contract. So I think, yeah, the two need to go hand in hand.
Yeah. But
in terms of the amount of the financing we're talking about for an FSRU, yeah, they're pretty long terms. I'm sorry, I can't be more specific than that.
Yeah. Okay.
Of course, I mean, Nick, the underlying charter in an LNG depot project as well will tend to be long term anyway.
Yeah. Yeah, and then the second part of the question was also which type of contract would be preferred by lenders, i.e. tolling or charter party. And I think actually they're not mutually exclusive. You could probably have a time charter with tolling. Yeah. Which actually, Joe, that leads to a question for you from me is, you've talked about the traditional FSRU ownership model where there's a traditional FSRU owner. When you look at some of the other projects that have been talked about at the moment, especially when there's not necessarily a power plant or where it's gas to industry, they're talking about the actual project owning outright the FSRU itself. Yeah. What are you seeing, and what's the benefits and downside risks of that kind of structure?
Yeah, thanks, Nick. I think in some structures it's not a choice because of local law requirements requiring beneficial ownership of a company incorporated in the host jurisdiction. So I think to a certain extent that has been dictated to by local law legislation. Although saying that, there are of course projects, I'm thinking one in particular in Turkey, whereby the project developer owns the FSRU and then has contracted to a third-party operator for its operation and maintenance. But I think in general terms, and obviously in terms of the webinar, we were discussing the position of the traditional FSRU sponsors, and we all know who they are, and their business is the construction and operation of FSRUs. It is not currently the provision of third-party services. Needless to say, it's all a question of course of commercial terms. But I think realistically, I mean, obviously, there's no reason for that particular sector not to be more employed in terms of contracts. But I think it is an issue as to the differential simply in pricing between a project owning and then having a third party operate its asset as compared to leasing in both the asset and the services. And secondly, actually, also a question of appetite of risk from the third party operator. I mean, will a third party operator be prepared to take the level of risk that a traditional sponsor who has both the asset, the additional sponsor who is operating its asset is likely to probably take, a more level of risk in terms of pass through of demurrage and other damages claims. So, absolutely no reason not to that either construct cannot work. I think it's just a question of numbers and appetite.
Okay, so another question. In LNG to power projects which have planned secondary revenue streams, for example, ambitions to sell small-scale trucking networks, will lenders consider the secondary cash flow in an assessment of the project's bankability? And I think all of you can probably have a crack at that, but I mean, Gary, I assume any additional revenue and alternatives.
Yeah, I think Nick, I think the answer is yes. If there's another revenue stream, then that's obviously going to be of interest to any lenders.
Yes, and I think that's also from a contractual mitigant point of view, that's very important. If you have more than one off-taker, if things go wrong with one of the off-takers, then obviously the more outlet you have elsewhere, the better it is.
Well, it looks as if Nick, unfortunately, has had some technical issues. We are past our time, so perhaps I should just take the opportunity to thank everybody for attending. As I say, if you have any further questions, please please pass them on to any one of the four of us who's been on this webinar. And again, thank you very much for attending, and have a very good day.